Bitcoin ETF. Why is it good for crypto market? Many industry players and analysts at traditional financial institutions have long called cryptocurrency ETFs the tools that could truly change the rules of the game.
Game has changed, yo.
Bringing institutional investor attention, liquidity, and replicating the success of gold-focused exchange-traded funds to the industry. In October 2023, Cointelegraph reported on the approval of BlackRock's application to launch a spot Bitcoin ETF. Amid the incident, quotes of the first cryptocurrency broke through the $29,000 level. Later, it turned out that the journalists had published unverified information, and the investment company was still waiting for the regulator's decision. However, such reaction of the market proved once again that its participants expect a lot from these instruments. In this video, we take a look at what impact spot Bitcoin ETFs can have on the cryptocurrency market, and whether it is correct to compare them to gold-focused exchange-traded funds. What is an ETF? An exchange-traded fund, ETF, is an index fund that, depending on its structure, tracks a specific sector, a specific commodity, or even a specific strategy. Unlike other investment funds and trusts, like Grayscale Bitcoin Trust, GBTC, ETF shares are freely tradable on the open market. They can be traded in the same way as securities, selling or buying units at any time during the trading session. This makes the instrument liquid and, as a result, provides investors with the possibility of instant withdrawal. The product also allows optimizing management costs, as it can track a basket of assets and has a low financial entry threshold. For the traditional market, exchange-traded funds are a familiar instrument. For example, in the U.S., the first ETF appeared in 1993. It is Standard & Poor's 500 Depository Receipt, SPDR. It tracks the S&P 500 index and is still actively traded under the ticker SPY. However, cryptocurrency exchange-traded funds are relatively recent and not exactly what the community expected. A landmark was the launch of ProShares Bitcoin Strategy Futures ETF, BITO, which the U.S. Securities and Exchange Commission, SEC, approved in October 2021. Compromise solutions. The Commission has long opposed the launch of exchange-traded funds for digital assets. The regulator's arguments included the lack of qualified custodial services in the U.S. and the lack of a compliance culture to prevent fraud. The SEC ultimately approved an ETF based on the Chicago Mercantile Exchange, CME, settled Bitcoin futures, which includes the aforementioned BITO. The CME is a federally regulated market. The platform is overseen by the U.S. Commodity Futures Trading Commission. Bitcoin futures on CME. CME launched Bitcoin futures in December 2017. In the same month, the price of digital gold hit an all-time high. In January 2017, a correction occurred and a long flat period began. Quotes reached the previously established peak only in November 2020. Since Bitcoin futures appeared almost 6 years ago, there are already studies that aim to assess the effect of launching the instruments. Opinions vary in this context. Some believe that the emergence of the futures market has increased Bitcoin's liquidity and made it more attractive than other cryptocurrencies in terms of risk-return ratio. Others, on the contrary, made conclusions about destabilizing influence of the instruments. The inflow of liquidity was too small to have a significant positive effect, but the market volatility increased, its profitability decreased, and risks increased. Launching BITO. BITO shares started trading on the New York Stock Exchange on October 19, 2021. The instrument showed one of the most successful debuts in terms of trading activity. In the first session, its turnover amounted to 24.42 million shares. The volume almost reached $1 billion, and it took BITO only 2 days to overcome this milestone. Less than a month after the launch of BITO, Bitcoin quotes hit an all-time high of $69,000 before going into a deep correction. After BITO, other similar instruments appeared. Most likely, at the moment they did not have a significant impact on the price of the first cryptocurrency. As in the case of CME futures, their launch occurred at the end of the rally, when the market was laying the upcoming correction. In addition, the community has already spoken about certain problems in the Terra ecosystem. However, one cannot turn a blind eye to the fact that institutional traders were able to take short positions against Bitcoin when it reached its price maximum. That is, to make money on the fall of the Bitcoin price. In the long term, futures ETFs have increased the liquidity of the cryptocurrency market and attracted the attention of more traditional players. The SEC's approval of the instruments also removed the overhang of the narrative regarding the possibility of the regulator imposing a ban on transactions with digital assets. At the same time, specialists of the Bank for International Settlements believe that with a certain concentration of derivatives under the management of exchange-traded funds, the latter may have a negative impact on the market, in particular, by increasing its volatility. Some have also noted that CME futures are becoming increasingly important as the market becomes more institutionalized. This is especially noticeable during the recovery of cryptocurrency quotes. It is likely that it is Bitcoin ETFs, like BITO, that make a significant contribution to the dynamics. Ineffective correlation. Bitcoin futures, ETFs, interested institutional market participants, because they provided them with access to cryptocurrency through a clear and regulated mechanism. But such instruments have a number of features that significantly reduce their effectiveness. One of the objectives of any exchange-traded fund is to accurately track a particular index. However, because futures quotes are influenced by a number of factors such as the expiration date, ETFs based on these derivatives often correlate inefficiently with the underlying assets. For a futures ETF, the management company opens long positions in short-term derivatives. In the case of BITO, these are CME Bitcoin futures. As the expiration date of the contracts approaches, it closes positions and opens new ones in instruments with a longer maturity, rollover operation. In addition, the management company holds liquid cash or cash equivalents like treasury bonds. When quotations of the underlying asset rise, it uses the profit from derivatives to expand the liquid pool. In the reverse situation, the pool offsets losses on the contracts. This strategy can negatively impact the ETF's performance over time as it causes its quotes to lag behind Bitcoin prices. Since the beginning of 2023, BITO stock has lagged spot Bitcoin by 2.6% to 13.8%. However, this changed in the fourth quarter. As of December 8th, ETF quotes outpaced net asset value most of the time. How does a spot ETF differ from a futures ETF? Spot ETFs do not invest in derivatives, but directly in assets, in our case, Bitcoin. Therefore, while they have all the advantages of futures exchange-traded funds, they lack a number of their disadvantages. Operators of spot Bitcoin ETFs, if such instruments do get approved in the U.S., will hold the cryptocurrency in the accounts of registered custodians. Judging by the filings with the SEC, most management companies have chosen Coinbase custody as such. The exceptions are entities that have similar services under their control. With the exception of the object of investment, spot ETFs are no different from futures ETFs. Their shares are traded on the open market in the same way, and the objective is to track a specific index. However, the very fact that derivatives are excluded increases the efficiency of the instrument. Since the management company directly owns the target asset, the fund tracks its quotes more accurately. Moreover, a spot ETF offers more attractive commissions due to low transaction costs. This will be especially noticeable for long-term investments. Some analysts also see such funds as less volatile compared to futures structures and trusts like GBTC. Can spot Bitcoin ETFs be compared to gold funds? Positive views prevail in the community regarding the impact that spot exchange-traded funds could have on the cryptocurrency market. One view of future developments is inextricably linked to the narrative that compares these instruments to gold ETFs. According to Galaxy Digital, in the first year of trading, the inflow of funds into spot Bitcoin ETFs could exceed $14 billion, which would provide a 74% increase in the quotations of the underlying asset. The analyst's estimate is based on the assumption that 10% of all institutional investors are invested in Bitcoin, with an average allocation of 1%. As one of the arguments, they also cite the effect that ETFs have had on the gold market. Other experts additionally point to the systemic scarcity caused by Bitcoin's halving cycle and the existence of a stable group of long-term holders of the asset who have no intention of selling it. Indeed, since the launch of gold-oriented exchange-traded funds, the price of the precious metal has roughly quadrupled. At the time of writing, the value of assets under management of gold ETFs, whose shares are traded on the U.S. market, is estimated at more than $115 billion. ETFs have provided a huge influx of liquidity into the gold market due to one simple fact. They have democratized access granted to the precious metal for both institutional and retail investors. Before the advent of trust funds, investing in gold was quite problematic. It was necessary to purchase physical bars or coins, transport them, and then take care of their preservation. All this cost money, and the market was fragmented and illiquid. Therefore, institutional investors had to bear the associated costs, and retail investors practically did not participate in large transactions. Gold-oriented funds solved these problems. For institutional investors, Bitcoin futures and then derivative ETFs were supposed to do the same. However, as mentioned above, these instruments are not highly efficient, so spot funds are a much more attractive entry point. The retail user with cryptocurrencies has no such difficulties in principle. They have had direct access to digital assets through exchanges and other trading platforms for years. In addition, tokens are easy to store and transport, since the entire contents of the wallet take up exactly the same amount of space as a piece of paper with a CID phrase written on it. Given the above, it is not quite correct to compare spot Bitcoin ETFs with gold-oriented structures. Therefore, the effect of approving the instrument should be assessed more conservatively. What impact will spot Bitcoin ETFs have on the market? It is quite difficult to assess the short-term impact of spot ETFs on cryptocurrency quotes. On the one hand, for certain market participants, their approval may signal profit-taking, as may have been the case with Chicago Mercantile Exchange derivatives and futures funds. However, these instruments appeared at the end of the rally, while the situation with spot Bitcoin ETFs is different. The industry is just emerging from the bearish phase. On the other hand, being more efficient than futures funds and derivatives themselves, these structures can attract the attention of more institutional investors and, as a result, the liquidity necessary for growth. Some in the community also believe that ETF providers benefit from short-term quote drawdowns. This will allow them to attract assets at a lower rate. There is also a polar opinion. From the point of view of structures like BlackRock, it is more appropriate to gradually build up positions, trying to avoid impulsive impact on the price. Both scenarios are likely, so it is worth keeping in mind the potential increase in volatility. If we talk about the impact of spot Bitcoin ETFs on the industry as a whole, these instruments are de facto oriented towards institutional investors. For the latter, they simplify, expand, and optimize access to cryptocurrencies, among other things, by reducing the cost of servicing positions. It is also significant that following Bitcoin-focused funds, the market is likely to see structures accumulating Ethereum and other assets based on proof of stake. These ETFs have the potential to offer clients even greater returns through access to staking, both native and liquid. The only question is whether regulators will allow them to do so. If so, such instruments could also attract the interest of institutional players who will want to participate in DeFi via proxies. Industry companies such as exchanges, custodial services, and other service providers will also benefit from the approval of spot funds, as the infrastructure built around these products needs to be maintained. Theoretically, they will receive a huge influx of funding, which will have a positive impact on the development of the entire industry. Thus, even if spot Bitcoin ETFs do not repeat the success of gold-oriented products, the positive effect of their adoption will be felt by all market participants, including ordinary users. In the future, the latter will receive better and more reliable services, greater liquidity in the markets, as well as a whole range of new products catalyzed by institutional investors.